While everyone's chasing AI stocks and record highs, Buffett's doing the opposite. He's selling winners, stockpiling cash, and preparing for something big. The question is, are you ready for what he sees coming? Warren Buffett just did something he's never done in 60 years. He's holding more cash than his entire stock portfolio. And what comes next could rewrite your financial future. For 11 straight quarters, nearly 3 years, the world's most famous buyer has become a relentless seller. While markets hit record highs and investors pile into artificial intelligence and tech darlings, Berkshire Hathaway is sitting on a mountain of cash so massive it defies comprehension. We're talking about $340 billion in cash and treasury bills. That's more money than Microsoft, Google, and Amazon hold combined. More than Berkshire has invested in all of its American stocks put together.
This isn't caution. This isn't pessimism. This is preparation. Buffett doesn't make emotional decisions. He doesn't panic sell or chase trends. Every move he makes is a signal, a breadcrumb left by someone who has survived every market cycle since the 1950s. The dot-com crash, the 2008 financial crisis, the pandemic panic. He's seen it all. And right now, his actions are screaming something most investors refuse to hear. The question isn't whether Buffett sees something coming. The question is whether you're paying attention. In the next few minutes, you're going to discover the 10 biggest moves Buffett has made recently, pulled directly from Berkshire's official filings. You'll see which companies he's abandoned, which positions he's trimmed, and why his current strategy might be the most important lesson you'll learn about investing this decade. More importantly, you'll understand what you should do right now with your own money while there's still time to act. Because when the market is expensive, the smart money doesn't chase, it waits. And when Buffett waits this long with this much firepower, history suggests something extraordinary is about to happen. The sell-off begins. The quiet exit. When legends stop buying. Let's start with the moves that surprised almost no one but revealed everything. Buffett's recent portfolio changes aren't random, they're surgical. And they all point to one undeniable truth. He believes the market has gone too far, too fast. Move number 10 might shock you because it involves the very investment Buffett tells ordinary people to own. In late 2024, Berkshire sold every last share of its S&P 500 ETF holdings, SPY and VOO. These are the low-cost index funds he's championed for decades, the same ones he's recommended in countless shareholder letters and interviews. So why dump them now? This wasn't Buffett turning against index funds. It was Berkshire being ruthlessly efficient. Inside a portfolio that already owns Apple, Chevron, Bank of America, and Coca-Cola directly, holding passive ETFs creates redundancy. When you already own the best pieces of the puzzle, owning the entire puzzle becomes pointless. Buffett freed up capital, eliminated overlap, and prepared for precision strikes when opportunities emerge. The message is clear. The easy money has been made. Move number 9 tells a similar story, but with a different lesson. HP Inc. looked like a textbook Buffett play when Berkshire first bought shares in 2022. Stable cash flow, cheap valuation, products that aren't vanishing overnight. But by early 2024, every share was gone. Why? Because cheap doesn't mean valuable. HP faced shrinking margins, brutal competition, and a business model slowly losing relevance. Even with buybacks and dividends, the long-term economics were deteriorating. Buffett recognized the value trap before it became a decade-long anchor and walked away without hesitation. Then came Snowflake, the move that stunned the investment world. When Berkshire bought into this cloud data platform during its 2020 IPO, it felt impossible. Buffett doesn't do high-growth tech stories with no profits. Most assumed this was Todd Combs or Ted Weschler, Berkshire's younger portfolio managers, taking a swing at the future. And for a while, Snowflake's revenue exploded, from hundreds of millions to several billion in just a few years. But profits never followed. Every quarter brought more losses, more promises, more growth without cash flow. By 2024, Berkshire sold all 6.1 million shares and disappeared from the shareholder list. A beautiful sports car without an engine. That's how Buffett saw Snowflake. Exciting, but going nowhere. Move number 7 might be the most human moment in this entire countdown. Paramount Global. Buffett called it a mistake. When Berkshire first invested, it looked like a contrarian opportunity, a traditional media giant undervalued by a market obsessed with streaming. But the thesis crumbled fast. Streaming turned out to be more expensive, more competitive, and far less profitable than anyone predicted. Subscriber growth stalled. Debt piled up. Advertising revenue collapsed. By early 2024, Berkshire had exited completely, locking in what Buffett described as quite a bit of money lost. Even the greatest investors make bad calls. The difference? They don't let pride turn a mistake into a catastrophe. When the facts change, they change their mind. No ego, no excuses, just ruthless honesty. These exits share a common thread. Buffett isn't abandoning stocks because he's bearish on America or capitalism. He's abandoning stocks that no longer meet his standard. Durable competitive advantages, predictable cash flows, reasonable valuations. When a business loses its edge or its price detaches from reality, he doesn't hope for a turnaround. He moves on. Trimming the winners. Now we move into territory that feels counterintuitive. Buffett didn't just sell the losers and the mistakes. He trimmed some of his greatest wins. And that might be the most important signal of all. Move number 6 involved Citigroup, a banking position Berkshire quietly liquidated in early 2025. Roughly 14.6 million shares, gone. This wasn't because Citi was collapsing. It was because Buffett wanted focus. Banks thrive when interest rates, regulation, and credit quality align perfectly. But they can turn brutal when any one of those variables shifts. Citi, while solid on paper, lacked the fortress-like stability of Buffett's longtime favorite, Bank of America. So instead of spreading exposure across multiple banks, Berkshire concentrated where conviction was strongest. This is classic Buffett. Simplify risk, don't avoid it. Move number 5 took this principle even further. New Holdings, the Latin American fintech darling, was growing faster than almost any financial institution on the planet. By early 2025, revenue had soared from a few hundred million to over 8 billion. Profits jumped into the 2 billion range. Everything screamed success. Yet Berkshire sold its entire stake across multiple quarters, right at the height of optimism. Why? Because even great businesses can be terrible investments at the wrong price. New's growth story was dazzling, but the stock was already priced for perfection, and Buffett doesn't gamble on perfection. He once said, "Price is what you pay. Value is what you get." New was a fantastic company. It just wasn't a fantastic deal anymore. Then came T-Mobile. Move number 4. In an era where wireless profits were exploding, and the stock was up more than 65% year over year, Berkshire decided to walk away. Not in one dramatic exit, but slowly, methodically, across several quarters. By 2025, the position was closed. T-Mobile's profits had skyrocketed from $2.5 billion to $12 billion in just a few years. But its valuation had inflated right alongside those earnings. When future growth gets priced like certainty, it's time to cash the check. Even the best companies don't stay cheap forever. And when the risk-to-reward ratio flips, Buffett would rather take profits and reload later when the odds are in his favor again. These moves reveal something profound. Buffett isn't just a buyer of great companies. He's a manager of risk and valuation. He understands that holding a winner too long at the wrong price is just as dangerous as holding a loser too long out of stubbornness. Trimming isn't weakness, it's discipline. It's the difference between investing and depending. The crown jewels under pressure. Now we arrive at the positions that define Berkshire's current identity. The ones everyone watches. The ones that reveal what Buffett truly believes about the economy and the financial system. Move number 3 involves Bank of America, Buffett's favorite bank. Between late 2024 and mid-2025, Berkshire reduced its stake significantly, though it still holds around 605 million shares, a massive position by any standard. So why scale down something he once called his number one bank? Because even Buffett knows that too much of a good thing becomes a risk, especially in finance. Banks live and die by interest rates, loan demand, and credit cycles. When rates stay elevated, loan growth slows. Defaults creep higher. Returns flatten. Bank of America remains a fortress, but even fortresses face headwinds. So Buffett lightened the load without abandoning conviction. This is portfolio management at its finest. You can believe in a company's long-term franchise and still respect the cycle. When credit costs and regulatory pressures push returns toward average, you reduce exposure. When efficiency, buybacks, and spreads combine at attractive prices again, you press harder. Then comes move number 2, the one that sent shockwaves through financial media: Apple. For years, Apple was Berkshire's crown jewel, at one point representing more than half of the entire U.S. stock portfolio. But across 4 consecutive quarters, from late 2024 into 2025, Berkshire sold millions of shares. Even after this massive trim, Apple still accounts for roughly 22% of Berkshire's holdings, by far the largest single position. Why sell something that worked so spectacularly well? Because Buffett isn't just an investor, he's a risk manager. When one stock grows so large that it dominates your portfolio, you're no longer investing, you're depending. Apple's valuation had climbed to levels Buffett himself called optimistic. Trimming back meant rebalancing without abandoning belief in the company. And here's what most people miss. Trimming a winner isn't losing faith. It's locking in profits at current valuations while reducing concentration risk. It's the difference between greed and wisdom. The 340 billion weapon. Now we arrive at move number 1. The move that ties everything together. The move almost nobody saw coming until it was already happening. Berkshire Hathaway is sitting on approximately $340 billion in cash and U.S. Treasury bills. That's not just a record for Berkshire. It's a record in corporate history. More cash than Microsoft, Google, and Amazon hold combined. More than Berkshire has invested in all of its American stocks together. Let that sink in. A company famous for buying and holding is now the ultimate saver in a market obsessed with spending. But Buffett isn't hoarding for safety. He's building dry powder for opportunity. Cash isn't dead money. It's optionality. It's the freedom to act when others can't. Those treasury bills are paying close to 4% right now, which means Berkshire's war chest is generating billions while sitting still, waiting for the right moment. And history shows what happens next. When Buffett waits this long and piles up this much cash, something big is about to unfold. The 1990s, the 2008 crash, the 2020 pandemic panic. Every time he's built a fortress of liquidity, opportunity eventually arrived, violent, sudden, and lucrative. Right now, the U.S. stock market is more expensive than almost any time in history. The price-to-earnings ratio on the S&P 500 sits around 31, nearly double its long-term average. The Shiller P/E ratio, adjusted for inflation, hovers near 40, higher than before the 2007 housing crash and approaching dot-com bubble territory. Then there's Buffett's favorite metric, the Buffett indicator, which compares total market value to GDP. That number stands at roughly 217%, meaning the market is worth more than twice what the economy actually produces in a year. Historically, anything above 120% signals overvaluation. So what does Buffett do when every reliable metric flashes red? He does the opposite of the crowd. He sells into strength. He raises cash when others get greedy. And he waits patiently for the world to misprice something big enough for Berkshire to pounce. What you do next matters. So what do you actually do with everything you just learned? You don't need billions, insider access, or a finance degree to think like a professional. You just need a system that keeps you calm when everyone else is chasing noise. Start by watching cash levels. Every few months, check how much cash and treasury bills Berkshire reports. You don't need to copy trades. Just notice the trend. If cash keeps climbing, smart money sees fewer bargains. If it starts shrinking, opportunity is back on the table. It's like checking the weather before stepping outside. You can't control it, but you can choose when to bring the umbrella. Practice discipline instead of imitation. Most people obsess over what legends own. That misses the point. The real edge is emotional control, knowing when to trim, when to sit still, and when to admit you were wrong. Write down why you bought something and the one fact that would make you sell. When that fact changes, act. It turns emotion into logic. And logic always lasts longer than hype. Balance quality with price. A great company can still be a terrible investment if you pay too much. Growth stories are exciting, but if perfection is already priced in, you're not investing. You're speculating. Look for businesses that grow, earn real cash, carry modest debt, and trade at a price that leaves room for mistakes. Rethink cash. It's not dead money. Even small investors can earn while they wait. A simple treasury ETF or high-yield savings account pays you to do nothing until the odds tilt in your favor. Finally, prepare before panic. Make a short list. 5 to 10 dream companies you'd love to own if they ever fell hard. Keep that list somewhere visible. When fear floods the market, you won't freeze because you already know what to buy and why. Preparation beats prediction every single time. Right now, while the market celebrates and valuations soar, the smartest investor in history is preparing for what comes next. The question is, will you be ready when it does?